Ulta Beauty is the largest beauty retailer in the US with around 1,400 stores. At the current price, the company has a market cap of $23 billion with $122 million of cash on its balance sheet and no debt. Revenue over the last 12 months totals $11 billion with $1.2 billion of net income and $1.9 billion of ebitda. So Ulta's stock is now valued at just over 2 times revenue and 19 times earnings. That valuation seems reasonable, but there are signs that the business is slowing down. Revenue growth should come in at 9% this year, which is half last year's figure, and in May the stock dropped 28% after the company posted lower profit margins. Inflation has clearly hurt consumer demand, with the average sale per customer dropping by 1.5% in the first quarter. However, it's worth putting those numbers into perspective. Skincare and beauty products saw huge demand following the pandemic. Ulta grew its revenues 40% in 2022 and 18% in 2023, so some normalization is to be expected. Looking at the bigger picture, this appears to be an extremely well-run business. Revenues and profit margins have grown steadily over time. Gross profit margins, for example, have increased from 35% in 2015 to 43% today. And even during the pandemic, when the company had to close many of its stores, the company still managed to eke out a profit. Cash generation has also been impressive, with over $4 billion of free cash flow generated over the last 5 years, and a significant amount of this cash has been returned to shareholders in the form of share buybacks. Back in 2014, there were over 64 million shares outstanding. Today, that figure is below 49 million. If there is a criticism to be made of Ulta, it's that the company hasn't been aggressive enough in pursuing growth opportunities. The company has made no plans to expand overseas and doesn't even ship outside of the States or Canada. But that approach has advantages too. It gives the company better focus and makes it more immune to the slowdown currently happening in China. Company guidance suggests that comparative sales could increase 5% next year, which seems on the low side, but that doesn't include new stores. Ulta's successful loyalty program and its partnership with Target could help beat expectations. If Ulta can grow revenues at 8% a year for the next 5 years, then operate with a conservative 15% ebitda margin, ebitda in 5 years' time would total $2.4 billion, and an 18 times multiple would put the valuation at $43 billion. Account for share buybacks and the annualized return works out to almost 16% per year. This seems like a solid company at a good valuation. As a result, I rate this stock a solid buy, but these are my personal opinions, not financial advice, and I may buy the stock in the near future. For more investing videos, make sure to visit my website, 3minutebreakdowns.com. Thank you for watching.